Imagine walking into a dealership with a simple goal. You need a reliable car. You negotiate. You sign the paperwork. You drive home in something that smells new, looks perfect, and makes you feel like you finally made it. And for the first few weeks, it feels like one of the smartest purchases you have ever made. But there is a problem. The moment that new car becomes yours, something starts happening that most buyers barely notice. The car becomes worth less. You are still making payments. Insurance is still charging you. Fuel, maintenance, registration, interest, and repairs are still waiting for you. And while you are paying more every month for an asset that is losing value, someone else may be using your money to build wealth. So why do millions of Americans willingly choose the most expensive version of a product that usually gets less valuable every year? The answer is more interesting than depreciation. Because the real cost of a new car is not what you pay at the dealership. It is what that decision does to the next 5, 10, or even 15 years of your financial life. Welcome to Money Explained Differently, where we uncover the hidden side of money and explain the financial stories most people never see. Let's start with someone who made a decision that feels completely normal. Picture a 38-year-old American named David. He has a steady job. He pays his bills. He has a mortgage. He has some savings. His old car is 8 years old. It works. It is not exciting. The seats are worn. There are a few scratches. The infotainment system looks ancient compared with the newest models. Then one Saturday, David walks into a dealership. He tells himself he is only going to look. But then he sees it. A brand new SUV. Perfect paint. Perfect interior. Big screen. Advanced safety features. Quiet cabin. The salesperson doesn't begin with the total price. He begins with a monthly payment. About $650 a month. Suddenly, the purchase doesn't feel like buying a $40,000 plus vehicle. It feels like upgrading a lifestyle for the price of a few restaurant meals each month. David signs. And this is where the psychology of car buying becomes incredibly powerful. Because monthly payments hide the true size of the decision. People naturally think in monthly numbers. Rent. Mortgage. Phone bills. Subscriptions. So when someone says, "Can you afford another $150 a month?" the brain tends to compare that number with today's budget. It does not always compare it with the total cost of the vehicle. But the bank does. And the dealership does. Because the longer the loan, the easier it can become to make an expensive car appear affordable on paper. This is one of the biggest tricks in modern consumer finance. Not a scam. Not necessarily dishonest. Just a change in perspective. The question shifts from, should I spend this much money on a car? To, can I handle this monthly payment? Those are completely different questions. And once you understand that, you can see why a new car can quietly become one of the most expensive financial decisions an average household makes. But this is where most people get surprised. The dealership isn't the only reason the purchase becomes expensive. The car itself is only the beginning. Think about David's first year. He has the loan payment. Then insurance. And depending on where he lives, registration and taxes. Then fuel. Then tires eventually. Then maintenance. And somewhere in the background is the opportunity cost. That sounds complicated, but the idea is simple. Every dollar has a job. If you use a dollar to pay for a depreciating asset, that dollar cannot simultaneously be used to buy an appreciating one. That could mean paying down expensive debt. Building an emergency fund. Investing in a retirement account. Saving for a home. Or simply keeping more cash available for the unexpected. This doesn't mean every dollar spent on a car is a bad dollar. A car can be essential. For many Americans, it is how they get to work, take their children to school, visit family, and maintain a normal life. The mistake is not owning a car. The mistake is confusing transportation with status. And those are two very different purchases. A reliable used car and a brand new luxury SUV may both take you from point A to point B. But financially, they can produce completely different outcomes. And here's the part people often misunderstand. New cars do have advantages. You usually get the latest safety technology. You may get a factory warranty. You can choose exactly what you want. There is less uncertainty about how the vehicle was treated before you owned it. For someone who keeps a car for many years, drives heavily, and values reliability, buying new can absolutely make sense. So this isn't a story about everyone being foolish for buying new. It is a story about paying for things that provide little or no long-term financial return. And one of those things is the feeling of being new. Because consumers aren't just buying transportation. They are buying emotion. A new car smells different. It looks different. It signals success. It creates a sense that life is moving forward. And advertisers understand this better than almost anyone. Cars are rarely marketed as 4 tires, an engine, and a financing agreement. They are marketed as freedom, adventure, confidence, family, power, success, a fresh start. You aren't shown sitting in traffic calculating depreciation. You're shown driving along an empty coastline with perfect lighting. And there's nothing wrong with wanting that experience. The problem begins when the emotion lasts for a few months, but the financial commitment lasts for years. This happens in other areas of life too. Someone buys a bigger house because they got a raise. Uses a credit card because the payment looks manageable. Takes a vacation on borrowed money. Upgrades a phone every year. None of these decisions automatically creates financial trouble. The danger comes when lifestyle inflation quietly becomes permanent. And cars are particularly dangerous because they combine emotional appeal with a very large price tag. Now let's go back to David. After a couple of years, the excitement has faded. The car is no longer new. It's simply his car. The payment remains. Maybe his income hasn't increased as much as he expected. Maybe groceries cost more. Maybe his property taxes went up. Maybe childcare became more expensive. Maybe an unexpected medical bill appeared. And suddenly that $650 payment doesn't feel small anymore. This is where a car can stop being transportation and start becoming a financial constraint. Because fixed monthly payments reduce flexibility. And flexibility is one of the most underrated forms of wealth. A person with lower monthly expenses has more choices. They can change jobs. Take a break. Handle an emergency. Invest more during a market downturn. Pay off debt faster. Save for a house. Help a family member. Or simply sleep better at night. The person with a huge stack of monthly commitments has fewer options. That is the hidden cost. Not just money. Freedom. And there is another problem. Your income can change. Your expenses can increase. But your car payment doesn't care. The lender still wants its payment. That is why borrowing decisions should never be based only on whether today's income can handle the payment. They should be based on whether your finances can survive a bad year. Because the goal of personal finance isn't to look rich during good times. It is to remain financially stable when life becomes unpredictable. Now consider another American household. Instead of buying a brand new $45,000 vehicle, they buy a dependable 3-year-old car. Maybe it is less exciting. Maybe it has a few scratches. Maybe the previous owner already absorbed a large portion of the initial depreciation. They still spend money. They still need insurance. They still need maintenance. But their starting cost may be dramatically lower. And perhaps they invest the difference. That's where the story changes. Because wealth is often built in the space between what you could spend and what you choose not to spend. A person doesn't become financially secure because they found one magical investment. They often become secure because they repeatedly make ordinary decisions that leave money available for tomorrow. But there is another side to this story. Buying used isn't automatically smart. A cheap car with major mechanical problems can become expensive very quickly. A vehicle with poor maintenance history can create repair bills that wipe out the savings. And older cars can come with their own risks. So the smartest choice isn't automatically buy used. It is to separate the emotional purchase from the practical decision. Ask: what is the least expensive reliable transportation I can realistically live with? That question sounds boring. But boring financial decisions often create exciting financial results. Think about how a mortgage works. When someone buys a house, they usually understand they are making a massive financial commitment. They think about interest rates, down payments, property taxes, maintenance, insurance, the length of the loan. But with cars, people often focus on the monthly payment and the appearance of the vehicle. Why? Because a house is usually seen as an asset. A car is seen as lifestyle. And that changes how people think. Now here's where things get even more interesting. The automobile industry is a business. Dealerships need to make money. Banks and finance companies need to make money. Manufacturers need to sell vehicles. Insurance companies need premiums. And entire ecosystems exist around getting consumers into newer cars. That doesn't mean everyone involved is acting maliciously. It means you should understand the incentives. A salesperson is not trying to maximize your retirement account. A lender is not trying to minimize your lifetime interest cost out of kindness. A manufacturer is not trying to convince you to keep your old car forever. They are businesses. Their job is to sell products and generate revenue. Your job is to decide whether the purchase improves your financial life. And that distinction is critical. Because the most dangerous purchases aren't always the ones you can't afford. They are the ones you can technically afford but probably shouldn't buy. This is where people get trapped by what I call lifestyle mathematics. You earn more. So you upgrade the car. You get a bigger house, a nicer phone, more expensive vacations. Then your income rises again. And somehow, you're still asking where all the money went. Your salary increases. Your lifestyle consumes the increase. Your net worth barely moves. This can continue for decades. And eventually, someone with a six-figure income can still feel financially stressed. Meanwhile, another person with a lower income may have built substantial savings simply because they kept their fixed expenses under control. What do you think? Is buying a new car actually worth it for the average American, or has modern car culture convinced people to spend more than they need? Share your opinion in the comments. Because there is no universal answer. And that is important. A new car can be a rational decision. Maybe you have significant savings. Maybe you plan to keep the vehicle for a very long time. Maybe you drive enough that reliability matters enormously. Maybe the total purchase price fits comfortably within your broader financial plan. In that situation, buying new may be completely reasonable. But if buying the vehicle means draining your emergency savings, stretching the loan across many years, carrying expensive debt, or delaying retirement contributions, then the car is no longer just a transportation decision. It is competing with your future. And that is the part people often miss. A car doesn't just cost what appears on the window sticker. It can change what your money is able to do later. Imagine two people in their 30s. Person A buys an expensive new vehicle and upgrades it every few years. Person B keeps reliable cars longer and invests the money that would have gone toward constant upgrades. Neither person may notice much difference in year 1. By year 3, maybe not even. But over 10 or 20 years, the consequences of repeated decisions can become enormous. That's the power of compounding. Not just compounding investment returns. Compounding habits. A financial habit repeated every few years can quietly shape an entire lifetime. And this is why the most important question isn't, can I afford this car? It is, what else could this money be doing? Could it reduce debt? Could it strengthen your emergency fund? Could it buy part of a house? Could it increase retirement savings? Could it create a business opportunity? Could it simply make you less dependent on your next paycheck? Those questions turn a car purchase into something bigger. A decision about freedom. And there is one final trap worth talking about. The upgrade cycle. You finally pay off the car. For the first time in years, the monthly payment disappears. And instead of keeping the car for another 5 years, the next shiny model appears. The salesperson says something like, "You already know you can handle this payment." And that's the trap. People often become comfortable with payments instead of becoming comfortable with ownership. The goal should not be to always have a car payment. The goal should be to eventually have financial control. A car payment can be normal. It can even be useful. But permanent payments on depreciating things can quietly keep you from building assets that become more valuable over time. So what should someone actually do? Start by deciding what the car needs to accomplish. Not what you wish it could say about you. How reliable does it need to be? How long will you keep it? How much cash will remain after the purchase? What happens if your income drops? What happens if an emergency arrives 6 months later? And perhaps most importantly, would you still want this car if nobody could see it? That question can be surprisingly powerful. Because once the status disappears, you may discover that what you really wanted was reliability, comfort, safety, and convenience. And you may be able to get those things without buying the most expensive version. The biggest lesson is not that new cars are bad. It is that financial mistakes often hide inside perfectly normal decisions. Buying a house. Using credit. Upgrading a phone. Financing a car. Taking a vacation. None of these things are automatically irresponsible. But every dollar has an opportunity cost. And when your money goes toward things that lose value, you have less available to buy the things that can build value. That is the hidden side of the new car decision. The car may make you feel richer. But wealth is not what you drive. Wealth is what you own. And sometimes the most financially intelligent person in the parking lot is the one driving the oldest car they can comfortably live with. Because while everyone else is looking at the badge on the hood, they may be looking at something completely different. Their savings. Their investments. Their debt balance. Their options. Their freedom. And that is the real difference between looking wealthy and becoming financially secure. If you want to discover more hidden truths about money, subscribe to Money Explained Differently. We explore the financial stories behind the decisions that shape everyday life.